Have you ever thought about how banks make money? While the banking industry as a whole might be fairly complex, the manner in which banks make money can be surprisingly simple to grasp. Here's a quick review of the several ways banks make money, as well as some essential characteristics of each. But before we go any further, let's take care of some basics, like: what is a bank? Banks are for-profit institutions that collect deposits and make loans. Deposits are funds that customers place in a financial institution with the knowledge that they can withdraw them at any time or at a certain future date. A loan is money given to a borrower that must be repaid with interest. Financial intermediation refers to the act of accepting deposits and issuing loans. However, a bank's operations do not stop there. Bank checking accounts are used by the majority of consumers and businesses to pay their expenses, putting banks at the heart of our payment system. Banks are the main places where people get loans for things like cars, houses, and education. They are also the main places where businesses, especially small businesses, get loans. Banks are often called the engine of our economy, in part because they do all of these things and also because they are an important part of how the government sets its monetary policy. Well, another basic question is, how do banks create money? Banks cannot lend out all of the deposits they receive, otherwise, they would run out of funds to pay out to depositors. As a result, they preserve both primary and secondary reserves. Cash, deposits due from other banks, and Federal Reserve System reserves are examples of primary reserves. Secondary reserves are securities purchased by banks that can be sold to meet short-term cash needs. These are often government bonds. The percentage of deposits a bank must keep on reserve, either at the local Federal Reserve Bank or in its own vault, is mandated by federal law. Excess reserves are any funds a bank has on hand after meeting its reserve requirement. Excess reserves are what generate money. This is how it works: assuming a 20% reserve requirement, you make a $500 deposit in your bank. Your bank keeps $100 to meet its reserve requirement but lends Ms. Smith $400. She spends the money on an automobile. The Save You More car dealership deposits $400 into its bank account. Their bank retains $80 on reserve but can lend out the remaining $320 as excess reserves. When that money is lent out, it becomes a deposit in a third institution, and the cycle begins again. As a result of this example, your original $500 has grown to $1,220 on deposit at 3 different institutions. This is known as the multiplier effect. The multiplier's magnitude is determined by the amount of money that banks must have on reserve. Now let's move into a detailed analysis of how banks make money from different streams. Traditional banks make money in a variety of ways, depending on the type of bank and its target clients. Some of the most popular methods include: Number 1, giving out loans and collecting interest on those loans. Community banks make their money primarily by lending money to local citizens and small companies. The funds are derived from depositor funds kept in various kinds of bank accounts. While many large banks make the majority of their revenue from interest, they derive a greater proportion of their revenue from non-interest sources than small banks. Large banks are frequently divided into sections that focus on distinct sorts of customers and services. Their commercial banking or retail banking sections, for example, may provide standard bank services like deposit accounts, such as checking or savings, and personal and business loans. Their investment banking departments, on the other hand, may help large businesses and governments raise money, manage their money, and invest the bank's money. Many banks make the majority of their money by collecting interest on loan funds, such as home loans, auto loans, or personal loans offered to clients. These banks provide loans to both small and large firms. Customers who hold a credit card and carry a balance may be required to pay interest on their credit card debt. Number 2, fees. Banks can also make a lot of money via banking fees. These might vary largely depending on the kind of account or service you have with the bank. These may include bank account fees. Banks may charge you a monthly maintenance fee for having a checking or savings account. You may also be charged fees to use bank-related services, such as withdrawing money from a non-bank ATM, making purchases with your credit or debit card in countries other than the United States, or receiving a money order or cashier's check. There may also be fees for bill payment services, overdrafts, and not having enough money in your account. Secondly, credit card fees. Cardholders may be charged an annual fee to open and use the bank's credit cards. Usage-based fees are also frequent for cash advances, balance transfers, late payments, and exceeding the credit limit. In addition to late fines, failing to make a payment 60 days or more beyond the due date may result in a penalty at an annual percentage rate, or APR. Thirdly, loan and service fees. Banks may charge fees when they make loans or sell other financial items like insurance policies. Instead of receiving interest from the borrower, some banks will make loans and then sell them to another financial organization. The bank may still profit from the loan origination fee and sale, or it may charge fees to service the loan. And then there is investment fees. Banks that provide investment services may receive fees for managing their clients' money and providing brokerage services, a fee each time you buy or sell a stock, for example. Banks that make or sell mutual funds, annuities, and other financial products may get commissions or fees. Number 3, another method banks often use to make money is through credit and debit card purchases. When a merchant accepts a credit card, he or she must pay a merchant discount fee. A percentage of the discount charge is paid to the issuing bank for cards issued by banks, such as Visa and MasterCard credit and debit cards. This is known as an interchange fee. Merchant accounts are also available from some banks for businesses that want to accept debit and credit cards. They can then charge the merchant for merchant processing costs on card-based sales. Number 4, investments. Banks may be able to invest their own money in addition to making money from the investments of their customers through fees and commissions. Number 5, advisory services. Some banks make money by serving as consultants to other businesses. Individuals and businesses may be persuaded to purchase research or investment ideas. Entities may also hire a bank to assist them with money raising, public offers, and mergers and acquisitions. And finally, commissions. Banks can team up with insurance agents, brokerages, financial services companies, and other businesses in exchange for a commission on customers they send their way. Meanwhile, now that we have taken care of the major purpose of this video, I would like to explain a couple of actions you can take to avoid bank fees as a bonus. Like I earlier mentioned, banks make money by charging fees to their clients, but there are methods you can use to avoid them. But while not all bank fees are avoidable, you can use these 6 guidelines to avoid losing money on unnecessary charges. Number 1, make use of online services. Most banks offer online banking services that allow you to access your accounts from anywhere in the world. Sign up for an online account or go into your bank's mobile app to make use of these services. Make sure you don't tell other people your login information and use good security measures, like a strong password or security questions. Number 2, keep an eye on your account balances. When you have access to an online banking platform or app, use it to monitor your accounts. Check your account balance to avoid being charged for insufficient funds or overdraft fees if you overdraw. Use this simple internet access to keep an eye on your account for any transaction problems or fraudulent activity. If you notice anything unusual, inform your bank right away. Number 3, set up automatic notifications and payments. Human error can lead to expensive bank fees. You can use your app or online banking platform to automate loan payments, receive notifications when a direct deposit is made to your account, and set alerts for when your balance falls below a certain threshold or goes into overdraft. Allow these processes to do the work for you, and you will never have to pay another bank fee again. Number 4, sign up for direct deposit. Another simple automated technique that can help you avoid unwanted costs or repercussions is direct deposit. Some bank accounts require a minimum balance to remain open, and the bank may impose a fee if your balance drops below this amount. Set up direct deposit to ensure that your hard-earned money reaches your account and stays there without incurring costs. Number 5, avoid overspending. Overspending is a good way to avoid being charged overdraft or NSF fees. Try to live within your means and avoid spending more money than you have. Create an emergency fund so you don't have to overdraw your account or take out a loan if something unexpected happens. Balanced money management and planning are essential for maintaining your financial well-being. Number 6, make use of free services. Many banks provide complimentary services such as free checking and savings accounts, money transfers, and free ATMs. Make yourself informed of these services and their limitations in order to make the most of them. To avoid ATM fees, utilize your bank's ATMs and select a free checking and savings account that meets your needs. In conclusion, banks must make money in order to stay in business, and they do so in a variety of ways. If you have a checking account, you are paying the bank fees to keep your money safe. If you have a personal loan, you are paying interest to the bank in order to borrow money. However, not all banks have the same income streams, and understanding how your bank produces money might help you learn how to save money for yourself. Banks make money by charging their clients interest and fees. By practicing proper money management, you may keep your money in your pockets rather than the bank's. Pay off your credit card in full every month to reduce interest payments, and keep an eye on your account balances to avoid being charged late fees. When you develop good money habits, you actively protect your financial well-being.